Welcome to the Deep Dive. Today we're jumping into the Q1 2025 earnings call for Kohl's Corporation.
Yep, we've waded through the transcript, and our mission, as always, is to pull out the key results, the strategy talk, and what management's thinking about the road ahead.
Basically giving you the important takeaways without you having to listen to the whole thing.
Exactly. Cutting through the noise.
All right, let's start with the numbers. What was the high-level picture for Q1?
Okay, so net sales were down 4.1% compared to last year.
And comparable sales.
Comparable sales, looking at stores open for the full period, they were down 3.9%. That little difference is mainly due to closing about 24 stores.
Got it. And the bottom line?
A net loss of $15 million for the quarter. That works out to a loss of 13 cents per share.
Okay, a loss, but how does that compare? I remember last year wasn't great either.
Right. And that's the context they highlighted. That loss of 13 cents per share is actually a 46% improvement from the $1.24 loss in Q1 last year.
So better than expected then.
Yeah, it beat their internal expectations, which, in this retail environment is something they definitely wanted to emphasize.
Definitely. Now, there was also a change at the top, right? An interim CEO.
That's right. Michael Bender. It was his first call. He talked about, being honored, seeing a lot of opportunity.
Does he have a retail background?
Oh, yeah. Extensive. Over 30 years, Walmart, L-Brands, PepsiCo, CEO of iMart Express. So definitely knows the industry, seemed energized, ready to steer things during this transition.
But is he changing the strategy or sticking with the current plan?
Good question. He was actually pretty clear on that. He emphasized the 2025 plan was already set, aligned with the board before he stepped in.
So focus on execution.
Exactly, executing that plan. He mentioned it's centered on customer priorities, collaboration, accountability, the usual operational pillars.
Okay, so let's unpack those customer priorities. What are the big focus areas for 2025?
They boiled it down to three main things. 1, offer a curated, more balanced assortment. 2, reestablish Kohl's as a leader in value and quality. And 3, deliver a fictionless shopping experience.
Makes sense. Did they say how it's going so far?
They noted Q1 was ahead of what they expected internally, and they're seeing some, let's say, early positive signs from the changes they're making.
But there's always a but.
But yeah, they were very upfront. This is a turnaround. It's going to take time, and there's still a lot of work ahead. No quick fixes.
Understood. Okay, let's dig into those first two priorities in assortment and value. This seems like where the real meat of the strategy lies. Starting with assortment, curated and balanced. What was the issue they're trying to fix?
The core insight they shared was basically they might have shifted focus a bit too much towards chasing new customers and brands.
And neglected the loyal base?
Kind of. They sort of de-emphasized products that were really important to their core loyal shoppers. So the goal now is clarity, making sure each brand has a purpose and just rebalancing the whole offering.
Okay, are they seeing any wins from shifting back? Any example?
Yeah, jewelry was a big one they highlighted. Apparently it got a bit lost in the shuffle during the big Sephora rollout.
Right.
But jewelry historically does really well with their Kohl's card customers, their most loyal group. So they reintroduced dedicated fine jewelry shops in 200 stores last fall. Wow. And in Q1, jewelry sales jumped 10%, mostly driven by those Kohl's card customers. They see more opportunity there.
That's interesting. A specific fix yielding results. What about a bigger category like women's apparel? That often seems tricky for retailers.
It is tricky, and they admitted it's been a challenge. They said they'd overdone it with some new brands in women's that just weren't performing.
So what's the plan there?
Finding that balance again. More depth in the basics, the essentials, making sportswear clearer, and importantly, cutting back on some of those underperforming market brands to reinvest in their own proprietary labels.
Any other bright spots in assortment besides jewelry?
Petites, actually. They rolled that out to all stores late last year. Q1 performance was strong, up high teens.
Really? Which brands?
They called out simply Vera Wang, and Lauren Conrad specifically, said it was working with both core customers and newer ones.
Okay. And then there's the elephant in the room, Sephora.
Huge piece. Absolutely critical. The rollout's done now, over 1,100 shops across the chain. It's almost a $2 billion beauty business for them now.
Wow. How did it do in Q1?
Sales were up 6%, comps up 1%. They're still gaining market share in beauty, which is key. Standouts were fragrance, hair, and makeup.
What's next for Sephora?
More newness in Q2. Expanding hair care, bringing in Glossier makeup, that's a popular one, and a push on men's fragrance for Father's Day. Performance is pretty much on track with their expectations. Comps slowing a bit, which, makes sense in year 4.
Got it. They also mentioned something called impulse queue lines. speeding up the rollout.
Yeah, think of those little curated displays often near the checkouts with grab-and-go items, high-turn stuff.
Impulse buys.
Exactly. They're putting them in another 600-plus stores this year, aiming for nearly all stores by Q3. They see it as really successful, especially in physical stores. Adds extra items to the basket, drives incremental sales.
Makes sense. Okay, let's pivot to that second priority. Reestablishing value and quality. What's the approach here?
It boils down to great products, great prices, and making their promotions actually deliver that value effectively. A huge part of this is boosting their own proprietary brands.
Why the big focus on proprietary?
Well, several reasons. They offer lower price points usually, but still with good quality. They're exclusive to Kohl's, giving people a specific reason to go there. And management really believes these brands resonate strongly with their core customers. They see a lot of upside in leaning harder into them.
Is it working yet? Are those brands performing better?
They saw sequential improvement from Q4 to Q1, about 400 basis points better, they said, driven by established names like Tech Gear, Flex and Active, Lauren Conrad, and they mentioned some new home brands, Mariana, Metelier, Mingolenko getting a strong initial response.
But still lagging overall.
Yeah, overall, proprietary brands are still underperforming the company average. Penetration is only around 30% right now.
What was it historically?
Closer to 50%. So there's improvement, but still a long runway and a big opportunity if they can get it back up. It's important for margins and for hitting those opening price points customers need.
Right. And the other part of value was promotions. What was the issue there?
Basically, their promotions became less effective over time. Why? Because the list of brands excluded from coupons just kept growing and growing. It got close to 50-50 excluded versus included, which, can really frustrate a customer who relies on those Kohl's coupons and Kohl's cash.
That sounds like another one of those self-inflicted issues they mentioned.
It really does. So they started fixing it. End of April, they began phasing in more coupon-eligible brands.
How's it going?
Early reads are positive, especially online, they said. The plan is to have most changes done by mid-August.
Just in time for back to school and holiday shopping.
Exactly. Strategic timing. This simplification, plus the proprietary brand push, is really aimed at that value-conscious customer, especially the middle and low-income shoppers who they noted are feeling the most pressure and trading down.
Okay, a clear effort to fix past mistakes and reconnect with that core value shopper. Let's talk third priority. Frictionless shopping experience, and maybe touch on operations too.
Right. Goal here is just making it easier, more reliable to shop in-store and online. They're looking at store layout, what they call trip assurance, and making the store more inspiring.
Store layout changes. Like what?
They gave examples based on data. Moving accessories to be right behind Sephora. Moving Junior's apparel to the front, across from Sephora.
Why those moves specifically?
Because analysis showed those shoppers heavily cross-shop with Sephora. They want to capitalize on that traffic.
And did it work?
They said they're very encouraged by Q1 results, even though the moves were recent. Accessories comp, excluding Sephora, was up 4%. Junior's only down 1%. Both way ahead of the overall company trend. So yes, they saw that increased cross-shopping.
Interesting. What about trip assurance? What does that mean?
Basically, making sure the stuff you expect to find is actually in stock, especially basics and essentials. They're tweaking buying strategies for more depth in key items.
Seeing the improvement.
Yes, better in-stock rates on core basics in Q1, particularly men's and kids, which outperform the company average. It's an ongoing effort to improve buying discipline.
And inventory overall, how are they managing levels?
Tightly controlling receipts. The plan is for inventory levels to be down high single digits by the end of the year compared to last year.
But Q1 was up slightly.
It was up 1.7%, but they explained that. It was due to tariff mitigation tactics, pulling some orders forward, holding some seasonal stuff, planned variance.
Gotcha. So sounds like some encouraging signs on the experience front too. What about overall operations and the financial nitty-gritty?
Yeah, they stressed operational discipline, managing costs tightly. The goal is more efficient company, freeing up money to invest back into growth.
And we saw that in the SG&A numbers.
Exactly. SG&A expenses down 5.2% in Q1. Saved money on store costs, marketing, and there was also an accounting shift related to credit expenses that helped.
Any other cost savings?
Depreciation was down $13 million less spending, plus those store closures. Interest expense down $7 million. Also, mostly due to lower lease costs from closed stores.
How did the channels perform against each other? Stores versus digital.
Stores actually did better, relatively speaking. Store comps were down 2.6%. Digital was down 7.7%.
Why the bigger drop online?
They linked it to the mix. Digital over-indexes in the home category, which was weak, and also with their core credit customer, who was also lagging in Q1.
But digital is responding to some of the changes.
Yes, they specifically said it's responding well to having more brands eligible for coupons now. Digital profitability is still decent, though slightly less than stores because of shipping costs.
And drilling down on customer segments.
They confirmed again. New customers and non-Kohl's card shoppers were strong. The lag is squarely with that core Kohl's card customer. But they saw that trend improving through Q1 as they made those investments back into jewelry, petites, proprietary, and fixed the coupon exclusions.
And the point about pressured consumers.
Yeah, reiterated that middle and low income groups are feeling it most. Trading down makes the value initiatives absolutely critical.
Okay, one more line item. Other revenue was down quite a bit. What was that?
Down 10% to $184 million. They said this was mostly an accounting thing. Some credit program expenses that used to reduce SG&A are now reducing other revenue because of how the partnership with the third-party credit provider is structured.
So not necessarily a reflection of the credit business itself tanking.
Less about the underlying health, though lower sales from the core customer does mean less accounts receivable being generated, which has some impact. But the main driver of the drop was accounting.
Okay, let's shift to the balance sheet, debt, and that crucial 2025 guidance. How are they looking financially?
Ended Q1 with $153 million in cash. Operating cash flow was actually negative $92 million a use of cash. Not totally unusual for Q1 retail, though.
CapEx plans.
$110 million spent in Q1. They're projecting $425 million for the whole year, finishing Sephora, Impulse rollouts, and expanding an e-com fulfillment center in Indiana.
Shareholder returns. Debt.
Returned $14 million in dividends, ended the quarter with $545 million drawn on their revolver. But the big news was the debt refinancing.
Right, they address that near-term maturity.
Yes, a really important move. They issued $360 million in new senior secured notes due way out in 2030. They're secured by some distribution centers.
And the plan for that cash?
Use it, plus some revolver borrowings, to pay off the notes that were coming due in July 2025.
So that pushes the debt concerns further out.
Significantly. Nearest maturity is now 2029. They said long-term debt is at a 10-year low, gives them breathing room, liquidity to navigate and invest. Big positive step.
Good to hear. Now, another external pressure, tariffs. Still a lot of uncertainty there. How are they handling it?
They sounded prepared. Mentioned their sourcing team has been diversifying production away from single countries since way back in 2017.
So they're not overly reliant on one place?
Less so. They acknowledged it's still fluid, mentioned a recent court ruling as an example, but the teams are actively working angles. Shifting production more, adjusting order sizes based on price sensitivity of goods, working with suppliers. The goal is minimizing the hit while still delivering value.
And does the guidance account for potential tariff impacts?
Yes, they were clear on that. Based on what they know now and the actions they're taking, they're maintaining their full year 2025 guidance.
Remind us what that guidance is.
Comparable sales down 4% to 6%, operating margin between 2.2% and 2.6%, and diluted earnings per share between $0.10 and $0.60.
So they feel they can handle potential tariffs within that range.
They believe they can mitigate the vast majority of the impact. They also noted, hey, if tariffs get paused or rolled back, that could actually be a positive for the consumer. But the guidance already factors in their current assessment of the risk.
And the margin guidance specifically. They seemed confident there.
Yeah, confident in hitting that 30 to 50 basis points of gross margin improvement they guided to. They said the proprietary brand improvements and the coupon changes are factored into that, driven by that favorable mix shift and inventory control.
Okay, let's jump into some key takeaways from the analyst Q&A portion.
Yeah.
That often adds extra color.
Definitely. A big theme was stability. The interim CEO basically said, look, the strategy isn't changing. It was set by the board before I got here.
Reassuring the market.
Right. He just kept hammering home. This takes time. It's about meeting customer needs, especially that squeezed middle income shopper. Use that phrase, kitchen table conversations about spending.
Why stick to the full year guidance after beating Q1 estimates?
Prudence, basically. Acknowledging the ongoing uncertainty and pressure on consumers. Didn't want to get ahead of themselves. They did say Q1 trends were pretty consistent week to week, except for one weather hit week.
Gross margin drivers got more attention too, right?
Yeah, they confirmed again. Better mix from proprietary brands is key. Quantified it as roughly 10-15 basis points margin gain for every 1% increase in proprietary penetration.
And penetration is only 30% now.
Exactly. So huge potential upside there if they can rebuild that business. Inventory management also helps margin, of course.
What about the store fleet? Any talk of mass closures?
No, they pushed back on that, said stores are healthy, profitable cash generators. The 27 closures this year are just normal hygiene. They like having lease flexibility, 80 plus coming up yearly for adjustments, maybe resizing. Found the thumb 5K square foot format might be too small, prefer 55K, but no big closure program expected.
Any more on Sephora?
Just confirmed it's fully rolled out using smaller 750 square foot shops in smaller Kohl's locations, 2,500 square feet in bigger ones. Still happy with performance, still gaining share.
And digital's underperformance.
They expect it to improve as the core customer comes back and the coupon changes fully take effect. It was dragged down by home and that core customer weakness. Profitability is okay, just lags stores due to shipping.
The core customer theme just kept coming back. What was the final word on winning them back?
Management was really quite blunt, said a lot of the lag was self-inflicted.
Like the jewelry and petites issues.
Exactly. Displacing jewelry, getting rid of petites, shifting away from proprietary, making coupons less useful. They admitted these hurt the core shopper, so the fix is literally reversing those things, bringing them back, flowing the right goods, fixing coupons, and they're seeing early positive responses from that core group to these changes.
Plus marketing and store improvements.
Yep. Marketing focused on reaching them, store adjacencies, making shopping easier, better in-stocks. It all ties back to answering those basic customer questions. What do you have? How much? Where? When?
What about national brands? Are they dialing those back?
Acknowledge they added a lot recently, but right now, customer demand is stronger for proprietary, so they'll keep offering national brands, but tune the mix. Said vendor talks are positive.
Gross margin outlook for the rest of the year.
Q2, likely similar year-over-year trend as Q1. Back half should see more benefit as that proprietary penetration hopefully climbs and boosts margins.
Any last points on women's or the credit business?
Women's is still tough, heavily impacted by that past shift away from proprietary. Moving back is helping in areas like juniors, but no timeline for overall positive growth yet. Intimates is a specific weak spot they're working on. Credit, again, that other revenue drop is mostly accounting. The actual business performance is okay, just held back a bit by lower core customer spending. Should improve as that customer recovers.
Okay. That brings us to our This Is Not Financial Advices segment, a moment for some purely theoretical brainstorming based on everything we've just discussed.
Absolutely. Let's be crystal clear. Do not make trades based on this. This is just kicking around ideas.
Right. So given this intense focus on fixing the self-inflicted wounds, impacting the core customer jewelry back, petites back, proprietary investment flowing, and the big one, making more brands coupon eligible by mid-August, right before back to school.
Okay, I see where you're going.
Could the cumulative effect of all these very targeted fixes, especially the coupon change landing right then, trigger a surprisingly sharp positive turn in sales trends, maybe even ahead of Q2 results announcement, or stronger than currently guided for the back half?
Interesting. So you're hypothesizing that these very specific operational levers aimed squarely at their known loyal base might gain traction faster or more powerfully than the market anticipates, especially if the timing with back to school and maybe some easing external pressures align.
Exactly. It's a scenario where the focused execution on fixing known problems potentially accelerates the narrative faster than the current cautious guidance implies. A bet on the fixes landing effectively.
It's plausible. Outrageously plausible, perhaps. It pulls together all those threads about correcting course and targeting the core. Again, purely hypothetical.
Purely hypothetical. Okay, so let's wrap up this deep dive on Kohl's Q1. They delivered results ahead of expectations, but still showed sales declines.
Yep. The story is all about executing that existing three-part plan. Fix the assortment, reassert value, especially via proprietary brands and better promotions, and make shopping easier.
And the laser focus is on winning back that core Kohl's card customer by undoing past missteps. We heard about early green shoots in jewelry, petites, and response to layout and coupon changes.
Plus, they shored up the balance sheet with the debt refinancing, giving them more runway, and they seem to have a handle on navigating tariffs within their maintained guidance.
So the path forward really hinges on turning those specific bright spots into broad momentum, especially with that key loyal customer.
And doing it while their main customer base is still feeling financial pressure. That's the challenge.
Which leaves you, our listener, with this final thought to chew on. As Kohl's executes these targeted fixes aimed squarely at the customer they lost ground with, could these operational improvements compound faster than expected through the critical back half of the year, potentially driving results that surprise compared to their current cautious outlook, even in a tough market?
Definitely one to watch.
Thanks for joining us for this deep dive. We'll catch you on the next one.